Something happened in the silver market that has never happened before. Not in World War II, not in Vietnam, not in the Gulf War, not in Iraq, not in any conflict in modern financial history. A major war broke out and silver crashed. Not a small dip, not a brief correction, a violent, historic collapse. Silver went from nearly $100 an ounce to $61 in weeks, while bombs were falling in the Middle East, while oil hit $112 a barrel, while the Strait of Hormuz, the channel that carries 20% of the world's oil, was effectively shut down. Every rule in the financial playbook said silver should have exploded higher. Every textbook, every historical chart, every analyst who has ever studied war and its impact on precious metals, they all said the same thing. War equals silver surge. Geopolitical crisis equals safe haven demand. Supply shock equals higher prices. And yet, silver crashed, and investors who followed the old playbook, who bought silver expecting the traditional response, lost serious money. So what happened? What is the macro override? And more importantly, why does understanding it mean that the real explosion in silver has not happened yet? That is what this video is about. Stay with me, because what I am about to explain is one of the most important things any silver investor needs to understand in 2026. On February 28, 2026, United States and Israeli forces launched coordinated airstrikes on Iran. The operation targeted Iranian military infrastructure and leadership. The world held its breath. And financial markets did what they have always done when a major war breaks out. They moved into safe havens. Gold surged, silver surged, oil surged. Investors scrambled. For the first few days, everything behaved exactly as expected. But then, on March 4, 2026, Iran closed the Strait of Hormuz, the single most important shipping choke point on the planet, the channel through which 20% of the world's oil supply flows every single day. The IEA described what followed as the largest supply disruption in the history of the global oil market. Brent crude surged past $120 per barrel, and then something completely unexpected happened. Gold started falling. Silver started falling fast. The Kobeissi Letter, one of the most widely followed market commentary services in the world, flagged it publicly. In just 3 hours of trading, gold and silver combined erased approximately $2 trillion in market value. $2 trillion in 3 hours, while a war was raging, while oil was exploding higher, while the Strait of Hormuz was closed. The financial world had never seen anything like it, and most retail investors had absolutely no idea why it was happening. The term macro override was used by market analysts to describe exactly what happened. Here's how it works. Normally, in a normal world, war drives investors into silver and gold. Fear creates safe haven demand. Supply disruptions create scarcity premiums. Geopolitical uncertainty drives hard asset buying. That is the textbook response. Thoughtful. But here is what the textbook did not account for. This war did not just create fear. This war created an oil shock. And that oil shock, the spike above $112 per barrel, set off a chain reaction that ultimately worked directly against silver and gold. Here's the chain. Oil spikes. Oil is in everything. Gasoline, diesel, jet fuel, fertilizer, plastics, shipping costs. Every good that is manufactured and transported anywhere on Earth carries the cost of energy. When oil spikes that dramatically, inflation expectations spike with it. Markets begin pricing in higher inflation for longer. And when inflation runs higher, central banks cannot cut interest rates. In fact, some analysts began pricing in the possibility of further rate increases just to contain the inflationary spiral. The U.S. Federal Reserve, which had been expected to cut rates earlier in 2026, held rates steady. Canada, Japan, the UK, and the Eurozone all followed the exact same move. No cuts. Higher for longer. And here is the critical link. Gold and silver pay no interest, no coupon, no dividend, no yield. When the risk-free U.S. Treasury bond is offering over 4%, the opportunity cost of holding gold and silver becomes a live calculation. For every institutional investor on the planet, why hold an asset that pays nothing when a government bond pays 4% in a world where rates are going higher? The answer, for many institutional desks, was you don't. Sell the metals, buy the bonds, capture the yield. That is the macro override. The war did not destroy silver's fundamentals. It triggered a macro chain reaction that temporarily overrode the safe haven narrative through the mechanism of oil, inflation, and interest rates. As market analysts at the publication Under the Market Lens put it directly, the war triggered the selling pressure, but a specific macro sequence amplified it. And that sequence is exactly the mechanism investors need to understand. Now let me take you inside what happened on March 23, 2026, because the mechanics of that day are the key to understanding everything that comes next. Silver had already been under pressure for weeks at that point, but March 23 was different. It was not just selling, it was a cascade. Here is what actually drove it. The 2025 bull run in silver and gold had attracted enormous leveraged positioning. Hedge funds, institutional desks, systematic trading algorithms, retail investors using leveraged ETFs, all of them had bought silver and gold, riding the momentum of 2025's spectacular rally. When silver surged 147% in a single year, that was the most dramatic annual gain for silver since 1979. Reflective. And all of that buying, especially the leveraged buying, created a situation that market analysts describe as crowded positioning. Too many investors on the same side of the trade with borrowed money. When the macro override chain activated, when the macro headwinds became undeniable, the leverage positions started unwinding. Key technical levels broke. Automated sell programs triggered. Stop-loss orders executed automatically. Margin calls forced institutional desks to sell silver to raise cash to cover losses elsewhere. Thin liquidity created what traders call air pockets, moments where prices fall sharply because there are simply no buyers at that level. The result was the most violent single-day move in silver since the 1980s. Silver crashed 17% in a day, and the $2 trillion number, the combined market cap destruction in gold and silver in 3 hours, was not just a dramatic headline. It was evidence of just how much leverage positioning had accumulated in the previous bull run, and what happens when that leverage gets force liquidated. But here is the critical thing most people missed in the carnage. The fundamentals did not change. Not one single ounce of silver became less necessary to build a solar panel. Not one EV needed less silver in its electrical system. The supply deficit did not shrink. China's export controls did not disappear. The COMEX vault drain did not reverse. The leveraged paper market was liquidated. The physical reality of silver was not. And that distinction between paper liquidation and physical reality is the entire thesis of what comes next. I want to separate silver from gold here, because while both metals crashed, the story behind silver's crash is fundamentally different, and understanding that difference is the key to understanding why silver's recovery will be fundamentally different too. Gold is primarily a monetary metal. Its price is driven almost entirely by real interest rates, the strength of the US dollar, and safe haven demand flows. When yields rise and the dollar strengthens, gold falls, full stop. That relationship is direct, clean, and logical. Silver is different. Silver has what analysts call a split personality. Approximately 59% of all silver demand in 2026 comes from industrial applications. Solar panels, electric vehicles, semiconductors, defense systems, medical devices, AI data centers, every laptop, every smartphone, every EV charging station, every weapons system deployed in the conflict currently raging in the Middle East. All of them require silver. And here is the crucial point. Industrial silver demand is what economists call inelastic. Inelastic means the demand does not change when the price changes. A solar manufacturer does not look at the silver price chart and decide to skip silver today. They need silver. Period. Every panel. Every day. A defense contractor building guided munitions does not stop using silver because the macro override happened. They need silver, every missile, every day. This industrial demand base is the structural foundation under silver's price. It does not get liquidated when hedge funds get margin calls. It does not disappear when bond yields spike. It sits there, quietly, persistently, relentlessly, consuming silver every single day while the paper market goes through its convulsions. And layered on top of this inelastic industrial demand, a structural supply deficit that has run for 6 consecutive years. Goldman Sachs analysts describe silver as the primary strategic metal of the green transition. Their words, not mine. And yet, in April 2026, silver is trading at $73 per ounce, down nearly 40% from its January all-time high, because the macro override temporarily disconnected the paper price from physical reality. The paper market panicked. The physical reality did not change. Exhales. What the macro override analysts correctly identified, but what most financial media has not fully explained, is that this pattern has played out before, almost exactly. Go back to 1973, the Arab oil embargo. OPEC cut oil supplies to the West in retaliation for U.S. support of Israel during the Yom Kippur War. Oil prices quadrupled almost overnight. Inflation exploded across Western economies. The Federal Reserve tightened aggressively. Real interest rates surged. And gold and silver? They did not immediately surge on the oil shock as most people expected. In the years immediately following the 1973 oil embargo, as inflation was running hot and the Fed was fighting it, precious metals went through violent volatility periods. But then something shifted. The oil shock worked its way through the global economy. Inflation peaked and began turning. The Fed eventually pivoted. Real yields compressed. And when that pivot came, silver went from approximately $6 an ounce in 1977 to $50 an ounce in January 1980, a more than 700% move in roughly 3 years. The analysts at FinancialContent wrote it directly. This event mirrors the market behavior seen during the inflationary spikes of the late 1970s and early 1980s, where high real interest rates eventually broke the back of a historic gold rally. Notice what they said. Eventually broke the back. Not immediately. Not overnight, eventually. The oil shock causes the rate spike. The rate spike causes the metals crash. The rate spike eventually causes a recession or forces the Fed to pivot. The Fed pivot causes real yields to fall. Real yields falling removes the opportunity cost of holding metals, and the metals, especially silver, whose industrial fundamentals never change throughout, resume their structural move higher. We are currently in the middle phase of that sequence. The oil shock happened. The rate spike is happening. The metals crashed. We are now waiting for the pivot phase, and when it comes, the silver market has a structural foundation of industrial demand and supply deficit that did not exist in 1979, making the eventual move potentially far more significant. Let me show you something that the financial media is almost completely ignoring. While retail investors are panicking, while social media is full of people declaring the silver bull market dead, the largest institutional research desks on Wall Street have not moved their long-term price targets, not one of them. Goldman Sachs maintained its gold target at $5,400 per ounce by end of 2026. Their exact statement, which was covered by The Street, was this. They acknowledged the near-term risk but pointed to medium-term upside. If the Iran conflict accelerates diversification into gold and weighs on perceptions of Western fiscal sustainability, risks to the forecast are skewed to the upside over time. JPMorgan maintained a 2026 year-end gold target of $6,300 per ounce, a 30% gain from current levels. Their note during the selling stated directly that the fundamental drivers remain unchanged. For silver specifically, Goldman Sachs describes silver as forecast to average between $85 and $100 per ounce in 2026, calling it the primary strategic metal of the green transition. Bank of America maintained its silver target of $135. Now think about what these numbers mean in the context of silver at $73. Goldman Sachs is projecting silver to average between $85 and $100. Not peak at those levels. Average. Bank of America's target of $135 represents an 85% gain from where silver trades today. These institutions spent millions of dollars building these research models. Their analysts have access to data and supply chain intelligence that no individual investor can replicate. And every single one of them, despite the crash, despite the macro override, despite the oil shock and the rate spike, maintained their bullish silver thesis because they understand what the paper market liquidation obscured. The fundamentals did not change, only the positioning did. And positioning changes are temporary. Fundamentals are structural. Here's the brutal irony at the center of the macro override story. The very war that triggered the paper silver crash is simultaneously creating one of the most powerful silver demand surges in modern industrial history, from defense. And almost nobody is talking about it. According to Wikipedia's documented economic impact data on the 2026 Iran war, the second Trump administration declared that the arms industry quadrupled weapons production to meet the projected demand from ongoing military operations. Quadrupled. 4 times normal production. Now think about what that means in terms of silver. Every guided precision munition contains silver in its electrical systems. Every military communication system deployed across U.S. naval assets, Israeli air defense, Gulf Coalition command infrastructure contains silver. Every satellite in active military use over the conflict zone has silver in its solar arrays and electronic components. The Patriot missile interceptors being used to defend against Iranian ballistic missiles? Silver. The F-35 stealth aircraft conducting operations? Silver in every advanced avionics system. The military surveillance drones monitoring the Strait of Hormuz? Silver in every sensor array. Defense contractors are not checking the COMEX price before ordering silver for a weapon system being actively deployed in a war. They pay whatever they have to pay. They get the silver they need. They build the weapons. This is the most inelastic demand that exists in any industrial market. A nation at war does not negotiate on critical material costs, and yet, the paper price of silver crashed during this same war. That is the macro override. The paper market and the physical reality are pointing in opposite directions. The paper market says, yields are high, hold cash, dump metals. The physical reality says, defense is running at 4 times capacity, solar demand is at record levels, the supply deficit is now in its 6th year, and China locked 60 to 70% of refined global supply behind a licensing wall 3 months ago. 2 completely different stories. One price. And history shows us which story ultimately wins. There is a second layer to the silver story that even fewer people are discussing. The physical silver supply chain itself has been disrupted by the war, not directly. Silver is not shipped through the Strait of Hormuz the way oil is, but the disruption is real, and it runs through multiple channels. Channel 1, shipping costs. The closure of the Strait of Hormuz and the generalized threat to Middle Eastern shipping has caused global shipping insurance costs and logistics costs to spike. Silver shipments from mines in South America, from refineries in Asia, from vaults in London to industrial users in Europe and North America, all of them carry a higher cost in this environment. Higher logistics costs mean higher physical silver premiums on top of whatever the paper price says. Channel 2, India. India is one of the world's largest importers of physical silver. Massive industrial demand, massive retail and cultural demand. The disruption to Middle Eastern trade and shipping routes has complicated silver import logistics for Indian buyers. According to market data published in late March 2026, Indian retail buyers were paying premiums equivalent to approximately $74 to $77 per ounce in real purchasing terms, while the paper price was showing much lower. That premium is the physical market telling a different story than the paper market. Channel 3, China. China's silver export licensing framework, which locked up 60 to 70% of refined global silver supply on January 1, 2026, has not been suspended for the war, has not been relaxed, has not been modified. While the war rages, while the West scrambles. For critical industrial materials, Beijing's export controls on silver remain fully in force. The combination of China's supply restriction plus Middle Eastern shipping disruption plus record industrial demand plus the 6th consecutive year of structural supply deficit should be creating the conditions for the most explosive silver market in a generation. The only reason it has not happened yet is the macro override. The paper market is lagging physical reality, but the physical pressure is building. Every single day. So let us address the most important question. When does the macro override end, and what happens to silver when it does? There are 3 scenarios. Scenario 1. The war ends or de-escalates. If ceasefire negotiations succeed, if the Strait of Hormuz reopens, if oil prices fall back toward pre-conflict levels, the macro chain reverses. Lower oil prices mean lower inflation expectations. Lower inflation expectations mean the Fed can return to rate cuts. Rate cuts mean lower real yields. Lower real yields remove the opportunity cost argument against silver, and silver, with its intact industrial demand base and supply deficit, snaps back sharply. We already saw a preview of this. When Trump briefly signaled openness to ceasefire talks in late March, silver jumped intraday as investors immediately repositioned. The market is spring-loaded. Scenario 2. The war continues, but oil stabilizes. If the conflict grinds on, but oil finds a ceiling, perhaps through alternative supply routes, strategic reserve releases, or diplomatic pressure on OPEC, the inflation spike moderates. Bond yields stop rising, and the macro headwind for silver slowly diminishes. In this scenario, silver's industrial demand narrative begins reasserting itself as the dominant price driver. The physical market catches up to the paper price. Scenario 3. The oil shock causes recession. This is the most counterintuitive scenario, but arguably the most bullish for silver in the medium term. If the oil shock is severe enough to tip major economies into recession, the Federal Reserve, facing economic contraction, is forced to cut rates regardless of inflation. It happened in the 1970s. It happened in 2008. Extreme economic stress eventually forces central bank pivots. When that pivot comes, when rate cuts begin in earnest, the opportunity cost argument against silver collapses overnight, and a metal that is trading 40% below its January high, with structural industrial demand that never changed, faces a very different price environment. In all 3 scenarios, the direction of travel for silver is the same, higher. The only question is the timing, and the only question is whether you understand the difference between the macro override and the underlying structural reality. Before the market figures it out for you, let me give you the 5 specific things to track right now. Signal 1, U.S. 10-year Treasury yield. This is the single most important short-term driver of silver's price in the current environment. The 10-year yield climbed from around 4% to over 4.4% since the Iran conflict began. Watch this number every day. If the yield starts falling, if bond markets start pricing in rate cuts or recession, that is the green light for silver. Signal 2, Brent crude oil price. Oil is the transmission mechanism for the entire macro override. If Brent crude falls back below $100 per barrel, the inflation narrative weakens. If it stays above 110, the override continues. Watch oil first, silver will follow. Signal 3, Strait of Hormuz status. Any credible signal of the strait reopening changes everything overnight. Not just for oil, but for the entire macro chain. Watch ceasefire negotiations. Watch shipping insurance rates. Watch tanker movement data. Signal 4, physical silver premiums. What are dealers charging above the paper spot price? Normal premium, $3 to $5 over spot on a silver American Eagle. If you are seeing premiums of $8 to $12, the physical market is already pricing silver higher than the COMEX says it should be. That bifurcation always resolves in the direction of physical. Signal 5, COMEX registered silver, available daily on the CME Group website. Free, public, if registered silver continues to fall. While paper contracts remain elevated, the structural pressure in the paper market is building toward a forced repricing. Watch these 5 signals. Together, they tell you exactly where the macro override is in its life cycle. And when they turn, they will tell you that the real explosion is beginning. Let me bring this all together. Silver crashed during a war, and now you know why. It was not because silver's story is over. It was not because the fundamentals changed. It was not because the supply deficit reversed. It was not because China lifted its export controls. It was not because industrial demand collapsed. It was because a specific macro chain reaction, oil to inflation to yields to dollar strength, temporarily overrode the structural silver narrative. The paper market liquidated billions in leveraged positions. The physical reality of silver did not change by a single ounce. The war that crashed silver is simultaneously quadrupling. Defense weapons production. Every weapon needs silver. The solar farms still under construction around the world need silver. The EVs being built in factories across 3 continents need silver. The AI data centers consuming more power and more semiconductors than any time in history need silver. Goldman Sachs knows it. Bank of America knows it. JPMorgan knows it. Their price targets, maintained through the crash, maintained through the macro override, are all above the current price, some of them dramatically above. The macro override is a temporary condition. It has a beginning, a middle, and an end. We are in the middle. And when it ends, when the oil shock works through, when the Fed pivots, when the strait reopens or the market prices in the pivot, silver does not drift higher. Silver reprices, sharply, rapidly, in ways that leave most investors standing on the sideline, wishing they had understood the difference between the paper price and physical reality before the gap closed. The real explosion has not happened yet. That is not a promise. That is not financial advice. It is a structural observation backed by 6 years of supply deficits, China's export licensing wall, record industrial demand, institutional price targets far above current levels, and a paper market that just got force liquidated to a price that even Wall Street's most sophisticated analysts call significantly below fair value. The macro override is temporary. The fundamentals are permanent, and history shows us which one wins. If this gave you a clearer picture of what actually happened in silver and what the data says comes next, do one thing right now. Subscribe, because this story is not over. The 5 signals I just gave you, treasury yields, oil prices, Hormuz status, physical premiums, COMEX registered silver, they are moving right now, every single day. And every week we are going to be here, tracking the data, separating the paper market noise from the physical market reality, and showing you exactly where the macro override stands. Drop your answer in the comments right now. When do you think silver breaks $100 again? This year? By mid-2026? Or does the override run longer? Tell me what you think. I will see you in the next one.